So if you're interested in being an angel investor, there's a number of things that you should be thinking about to make sure you're successful as an angel investor, thinking about the long-term return. When I first got started, I really wasn't putting together a thought process around how I was doing angel investing, and this made me make a couple bets that maybe I wouldn't have made if I had thought about it in a more methodical way. I'm going to put together 4 core elements of being an angel investor, things that you should consider to make yourself more successful and make sure you're spending your time the right way. Number 1 is thinking about your performance and thinking about your investments, not as a one-off on one investment or one startup at a time, but really thinking about it in terms of a long-term portfolio view. And so a simple way to do this is think about what you would want to invest as an angel investor over the next, call it 3 years. In that 3-year time span, again, think about your total investment across a number of different startups investments and think about what percentage of your capital, your money, you want to allocate toward angel investing. Again, it's going to depend on who you are and your personal wealth. It may be 10% of your wealth, 1% of your wealth. It may be $1 million. It may be $100,000. It really depends on where you are personally and financially. Whatever number you are interested in investing over the next 3 years, take that number and divide it by 30. The reason we're dividing it by 30 is being an angel investor isn't about a single investment. It's really about a portfolio-based approach. And to have a portfolio-based approach, you need at least 25 investments. And so what we're doing is we're dividing your total investment over 3 years by 30 to give you 25 investments and 5 follow-on investments. And this really sets up the right ratio where you're investing in about 25 companies and you're not following on with every single company that you are investing. This makes you be really critical about your thought process on follow-on investing. A lot of the investment process is really putting more capital toward the companies that are growing really successfully and growing really quickly. It means doubling down on the companies. And so having this approach forces you to really be thinking about which companies you do want to follow on to invest in. Now, the second thing that you really want to be thinking about in terms of your approach as an angel investor is your time to money ratio. And again, I've seen angel investments spend a lot of time on diligence and researching and talking to founders and digging into a lot of the numbers and the data for what at the end of the day amounts to a small check. And really what you should be thinking of is your time as an angel investor should be proportional to the amount of time and the size of the check that you're spending. So if you're writing a really big check or a big check for you personally, then obviously you want to spend more time in diligence and vetting the founder, making sure you really have your ducks in a row. On the flip side, if this is a relatively small check, small size investment, you really should be able to make those decisions much quicker. Number 3 is you should consider what type of angel investor you are and how you are bringing value to the table. For the best deals, the quickest moving deals, entrepreneurs actually have the advantage and they can decide who they want in a particular deal, who they want to work with. So you should be thinking as an angel investor, what value do you bring to the table and what's going to give you an unfair advantage to get allocation or to get entrepreneurs and companies interested in working with you. So it could be a specialization, it could be your network, it could be your history, it could be something else, but think through what value you're bringing to the table, not just money. Again, money's great and a lot of entrepreneurs really want that capital, but to set yourself apart in the long term, it's going to have to be something in addition to money that you can bring to the table to unlock and accelerate companies in terms of their trajectory. And number 4, last but not least, is your thesis. Every single investor who's investing in, whether it's angels or VCs, is thinking about what their thesis is, what gives them an unfair advantage in the long term. It could be their knowledge or background, but ultimately this will account into a thesis or a proposition in terms of the types of companies that they're interested in investing. If you write down what your thesis is for yourself and vet that over time, and so it'll help you identify the companies that are really successful and why they're successful. Are they successful because they perfectly fit into your thesis or not? And so an example of a thesis may be, I only invest in entrepreneurs that are doing clean tech or biotech, because those are two areas of knowledge that I have. I know those fields, so I can open doors and connections. I will have an unfair advantage in those markets. Or another thesis might be, I only invest in companies in growth sectors that are growing over 100% year over year. And so my unfair advantage is knowing that the particular market is growing faster than the rest of the industry. Again, a thesis could be anything and everything, and it's really just your way of thinking and filtering through the companies that you're seeing to give you an unfair advantage. Again, thinking through what's going to help you as an angel investor be more successful is simultaneously going to help entrepreneurs identify who the best fits are for them to raise money with. I'm Raiz. I talk about entrepreneurship, technology, and design. I hope I'll catch you in the next one.